We're live. That was probably live as well. All right. So hi everybody. Welcome to another live. I'm here with Tatyana Bunich, and she is a financial wealth manager. Is that the right title for you? Financial
That's
wealth
great.
manager. And we are going to talk about today some tax pitfalls and cautions, things that you need to know when you're transferring retirement accounts and investment accounts in a divorce. That's generally one of the biggest things that we talk about from my perspective in a divorce, right? It's one of the things that people fight over a lot are the retirement accounts more so than other investment accounts, but retirement accounts being one of the big ones that people transfer or have to give up in a divorce in the equitable distribution. And I always tell people they need to go seek the advice of a professional tax person, wealth person, somebody to get some tax advice on any pitfalls, any type of penalties or gains or taxes they're going to have to pay on those transfers. So Tatyana, why don't you introduce yourself to everybody, give a little bit of background, tell them who you are, and then we'll talk about what those tax issues are.
Sure. I'm Tatyana, founder and CEO of Financial One Wealth. We do comprehensive wealth management, but really what we focus on is helping you retire and waking up every day in retirement, knowing you've achieved your dreams and you will not outlive your money. And we do that from the lens of tax efficiency, which is unique, and from the lens of legacy planning. So more money is left to your children and you pay less in taxes throughout. Legally, of course.
Always a big deal, right? Legally that we got to do that. So, all right. So Tatyana, let's focus first on the retirement in a divorce. What are some tax issues that people should look for or will they face? Sorry if I'm looking down. I'm actually pulling up our live on Facebook on my phone so I can monitor who's watching and anybody that we might need to give a shout out to or any questions that get asked. But what are some pitfalls or some tax consequences or anything that they need to be aware of when they are dividing first their retirement account? So what is the retirement account? So I think 401k is the big one that everybody knows about. So what are some other retirement accounts and then some of the tax pitfalls or things that they need to be concerned about in a divorce?
Yeah, so retirement accounts, most retirement accounts are tax deferred, and that is IRA, traditional IRAs, 401ks, 403bs, and if you work for the government, their retirement plan is called a TSP. So typically 403bs are for hospitals and colleges, universities. 401ks is for their general workforce, and TSPs is for the government. And the individual IRA accounts are for regular people who put outside of their job, who put into IRA accounts. And there's also Roth IRAs, which are different because they grow tax-free versus tax-deferred. A huge distinction there. That being said, all of those, in terms of a divorce, when they get split up, typically it's half goes to one spouse and to the other spouse, but the important thing is that they maintain their tax-deferred or tax-free status by remaining qualified. So the title still says IRA or 401k or 403b or Roth, just in the other person's name. And the reason that is because if that's not done properly, or what I have seen happen, the spouse that's getting the half will close that account and take all the money out. And that is a huge mistake. What they don't realize is that when they go to do their taxes the following year, 40 to 50% of that's going to go to taxes. If you live in a taxable state and you're under 59.5, it's going to be 50%.
Well, that is certainly a huge hit to take when you're dividing up the retirement assets. And so what can people do to protect themselves? So one of the things that as lawyers that we do when we are dividing up retirement accounts is we utilize what's called a quadro or a qualified domestic relations order, something like that it's called. It's quadro. And that's specific to the retirement accounts when we're splitting them up between spouses. And I know it can only be between spouses, right? In a divorcing situation that a quadro qualifies for. And so is that something that is used to protect the tax status so that they don't have, you talked about that 40 to 50% tax hit when they transfer the money? Is that what they use to avoid that?
Yes, that's exactly what they use to avoid that, because what happens is they're basically, let's say it's John and Mary, and if John has $2 million in an IRA. Now 1 million is Mary's and 1 million is John's, but the quadro allows it to continue to be an IRA.
Okay.
Where if John has 2 million and Mary gets 1 million and it's not, doesn't have that, and she's under 59 and a half and lives in a taxable state, her million just became 500,000. Let's just let that sink in. So that million just became 500,000, just like that.
Right. That is certainly, we just said, that's a huge loss that, like we talked about. Now, and that is something that you need to watch out for and be careful on. And you need to make sure that your attorney knows to do a quadro to protect that amount, because I've seen it, right, where quadros weren't done and in splitting of retirement accounts. And sometimes I've seen it done because the other party wants the liquid cash, right? And so, but like in the example that you gave of John and Mary, if John takes out $1 million from his $2 million retirement account, John has to pay taxes on that, right? Because he's taking it out not at a time where he's allowed to take that out of a retirement account. So what could John potentially face for doing that?
Exactly the same thing, 50%.
Okay.
It's not spouse to spouse. It just doesn't matter who the spouse is. If that money leaves the IRA or 401k or 403b, if it leaves that IRS designation, it will automatically get taxed right then and there. And it's about a roughly 30% federal, roughly 10% state if you're in a taxable state, and a 10% pre-59 and a half penalty.
Right.
That's very quickly get to 50%.
Right. And so, and that is taxed on that. And you said that goes on their next tax return. Is that where they see that?
Yeah. And so it's even worse than that, because now that million became 500,000. That million is income. So if your normal income's 100,000 or 200,000 or whatever it is, now your income's 1.2 million. So that 200,000 just went from a lower tax bracket into a much higher tax bracket, right? So now you're paying additional taxes on your regular income. So that could be another, 5 to 10% right there.
So
it's even worse. It could be worse than 50%.
Yeah, absolutely. So that is the importance of making sure that you get the right people on your team when you're going through a divorce to protect one, either if you're the one that has to give up the money from the retirement account, to make sure that it's done right so you don't get a huge hit that you have to take care of on your taxes. And then two, if you're the receiving spouse getting that money, that you're not getting a huge, income hit, right? And getting an increase in income. And also so that it's taken care of, so that maybe if the spouse is receiving it in a lump sum, that it's worded correctly, that the proper person is getting that tax hit applied to them correctly, if that's the way that it needs to go. So what about any other investment accounts, Tatyana? So something that's not considered a retirement account. So many times we have stocks, or we have other, mutual funds or any other type of investment accounts, and those sometimes also have to get split in a divorce. Are there the same protections, or is that something that we just have to account for? There's going to be some type of tax hit, and we need to go see a tax professional to really work up how that needs to be done.
So in regular investment accounts, you typically own stocks and mutual funds, and it's typically held in a joint account. So John and Mary own X amount of stocks or mutual funds or bonds. And because it's outside of an IRA account, it has gains, and those would be considered capital gains. So there's short-term capital gains and long-term capital gains. But let's just say it's long-term capital gains for simplicity of this conversation. And let's say that account is back to our $2 million account, but it's not IRA, it's just regular joint account. let's say in that $2 million account, 500,000 are gains. So 1.5 is principal and 500,000 are gains. When that gets split, each spouse now has $250,000 worth of gains in their portfolio if it's split evenly down the middle. Now, if it just stays that way and they do what's called an in-kind transfer, this is very critical. This is the distinction here. In-kind transfer. So if they own ABC Mutual Fund, it stays ABC Mutual Fund. And if there's 1,000 shares, they now each have 500 shares of ABC Mutual Fund. Then that gain stays with the mutual fund, but you don't pay taxes on it because you haven't sold it. You only pay taxes in regular accounts when you sell the securities, where you sell the holding. So if it's done properly, and now John has an account and Mary has an account, and 500 shares of ABC here and 500 shares of ABC there, so they have their capital gain, but you're not paying taxes on it because it's in kind and you still own the same holding. But if Mary decides to sell her half of ABC Mutual Fund, boom, now she's got a 20% capital gain tax, 15 to 20% capital gain tax on, and again, there's federal and states, I'm just using rough numbers, right there on that $250,000.
Okay. So that is where we commonly see then that, John owns, like you said, the $1 million, $2 million in ABC stocks. Sometimes I agree with you, most of the time it's held jointly, but sometimes it is just held in one of the person's names, but it's a marital asset. And so John now has to give Mary 50% of it in equitable distribution. And what we frequently see is that John just cashes out 50% and gives it to Mary, and Mary goes and puts it wherever Mary wants to put it. So now they're both having to deal with, well, if it's only in John's name, John's going to have that capital gains tax. But if it's in both their names, are they both now individually getting the capital gains taxes on how it's transferred, or is it just one capital gain for the transfer itself? Do you understand my question on that? So,
absolutely.
okay.
Absolutely. So it kind of depends on how they choose to file, but typically if it's a divorce, let's say it's 2021, in 2021, and they were still married at some point in 2021, and they go through all this in 2021 and all the legalities and all this gets split. If it's to some degree amicable, and I use that word very slightly because it's never truly amicable, but
right,
especially from the seat you sit in, there's a difference between everyone's at war and everyone's moving forward to the greater good of both parties, right?
Right.
So that's probably more along your mediation lines, right?
Right.
Versus the full-blown war in court. So in a full-blown war in court, typically they're going to file their own returns. They're going to go married filing separately, and they're each going to take a bite on that piece. But if John sold it all before he gave it to Mary, he's going to take the full bite on it. But when it's somewhat amicable and they're somewhat talking, they agree to file a joint return in that last year because it's typically more advantageous for both parties. So even though the following year, they're going to file single or married filing separate, depending on what happens. But in this transition year, let's call it a transition year, they're still going to file a joint return to help with some of these challenges.
Okay. And I just want to make sure that for clarity that we get everybody on the same page, and that so when these things are happening, right? So when John takes that half out and gives it to Mary, or they transfer, they don't do a quadro on their retirement account and they transfer money, and where they're going to get all these penalties or tax hits or capital gains taxes. Now, that's not something that they're paying right away, immediately, right? So as soon as they take it out, the IRS doesn't come knocking on the door and say, you now have to pay us 50%, right? So it's not until they go to the taxes that's due, where they have to then report that they did that on their taxes. And so can you explain how that works? So for instance, let's say it wasn't done properly, right? Let's go back to our $2 million, and it wasn't done properly and they're going to have that 50% or 40%, tax hit that they're going to have for it not being done properly. And so Mary now goes to file her taxes and has to report this on her taxes. What does that look like for her? What is she actually going to owe? How is it as estimated as you can, right? Obviously, we don't know the numbers. And what does that look like for her that she's going to be having to deal with?
So if we use our $250,000 capital gain, and let's say it's long-term, so it's, and let's say it's 15% taxes on the federal, and let's say that and they're in a taxable state. So let's just call it, for easy math, 20%. So what is that? Right around $50,000, right?
Mm-hmm.
Yeah. So that would be a $50,000 check to the IRS come February of the following year.
So that's something that then she's going to have to go see a tax professional, a tax lawyer, somebody for, and work out, which is a whole nother show. We won't go down offering compromises or anything like that. But now she's got to work out payment plans or offers and compromise or things like that with the IRS.
This is my favorite. Oh, this is my favorite, because I talk about this often when I do legacy planning, but this is a very similar situation in the end result. The outcome is very similar. I talk about it in legacy planning. So you have, a couple and they save all their money for their kids, and then they pass and the kids inherit the money, and it's IRA accounts. And, they call 1-800 Fidelity, 1-800 whoever, and they say, we're so sorry to hear about the passing of so-and-so. Yes, we've confirmed you're the beneficiary. We're going to send you out the forms, fill them out, send them back. They send them to the children, and the children can be, 20 or they could be 50, it doesn't matter. And then they get the form and they check box 1, send me the money. So it's the same thing here, send me the money, right?
Mm-hmm.
And then they send them the money, and if you're lucky, they'll withhold 20% federal tax and nothing for state. And then we go to do their taxes the following year, and all of a sudden they have this huge tax bill. And yes, that money was spent. So typically when a spouse does that liquidation, she's doing it to buy a house, to buy a car. She's doing it to make a purchase, to do a renovation on the kitchen or a renovation on the whole house, because she wants all the memories of him gone. So she's going to gut the house and make a whole new house, right?
Right.
Okay, so when that tax bill comes, there's no more money left. Nobody puts aside from this pot of money for taxes. No one thinks about it. So it's the same story with the IRAs and the kids who inherit. That's why it's like one of the biggest things I do is legacy planning to make it tax efficient, so these things don't happen. To save hundreds of thousands of dollars for people who've accumulated a lot of wealth for the next generation. And it's the same thing. So now she has a $50,000 bill, and to your point, she can't pay that bill. So she's going to go on a payment plan with the IRS. And to pay $50,000 to the IRS it's going to take a long, long time, and there's going to be interest involved. Mm-hmm. So that $50,000 can easily become $100,000 with interest over the years.
Yes, absolutely.
Who's the winner?
Right. Yeah. Right. Who's the winner? That is a great question. And I think a great question that we are going to leave unanswered and hypothetically let everybody sit and resonate with and end on. I think this has been so informative. And I hope that everybody watching has gotten a lot out of it. And Tatyana and I intend to do several more of these to bring this type of information to everyone on things that you need to look out for in a divorce when we're talking about wealth planning or wealth splitting in the divorce, any way that it needs to go, and what that looks like, and things that we need to watch out for, things that you need to make sure you know about, things you need to make sure your attorney knows about, and things that you're going to need to get advice from professionals on. And and this is one of those prime examples, Tatyana, and I love that we've talked about it, because I get asked all the time, especially in divorces where there's no kids and no home, and everybody's like, do I really need an attorney? And I think that this is one of those examples that I love that we did this, where I can say, yes, this is the reasons why. These are the things that people don't know about, that people don't know they need to think about. People don't know about quadros, and people don't know how to protect these assets when things have to be divided in a divorce. And so this is why you need the professionals on your side, and why you need to talk to people when we're talking about these important issues. So Tatyana, if somebody wants to reach you, how can they get in contact with you?
Sure. You can call 443-622-1226. Our website is www.financial1wmg.com.
All right. And of course, if you're watching this on Facebook, she is tagged in the Facebook Live. So you can find her there and find, I'm sure, all of her contact information as well as mine if you need to reach out to any of us. And you can reach out to me, and I can also get you in contact with Tatyana if you want to reach out to her. So thank you for being here, Tatyana. This has been extremely informational and valuable information. And so we will see everybody next time.
Thank you for having me.
Bye.
Bye.